Bubbles emerge in every facet of investing. They expand in size, get bigger, burst, and then again they start forming. We will explore a 5-point framework to help mitigate the impact of bubble bursts and market crashes. First, you do not know when the bubble is going to burst. Bubbles get built all the time. Everything gets pushed to an extreme till an equilibrium is restored. So build a method to protect against these bubble bursts. The biggest risk in a market crash is actually the period leading up to the crash, the formation of a bubble. When the market skyrockets up, people who are invested in these assets get richer and the poor who are not invested gets poorer. The easy money printing policy of central banks and the government schemes and subsidies in the hands of the middle income do not really help because they end up spending it buying products and services. And when they spend, money is transferred back to the rich. In oversimplified terms, chances of a bubble formation increases when the FD rates are less than inflation. Smart investors figure out keeping money in the bank loses its value and they start investing in stock market, driving prices even higher. When it comes to investing, we are all after different things. Some investments, we make huge returns. Sometimes we make small profits or minor loss. Unfortunately, some investment decisions leads to big losses. Spotting them may seem easy, but steering clear of these choices are tough. The main problem, greed. It's the strongest emotion that influences investing and often makes us choose bad decisions. Avoiding pitfalls of greed is a complex task as it tends to override rational judgment. Before investing in what's hot in the market right now, we must scrutinize the valuation. For example, small cap and momentum microcap investing today is a very hot theme. It's crucial to check if they are really worth the investment risk. Recognizing and managing emotion, like keeping greed in check, are crucial to avoid it. The third is the sleep test. Are some of the investments that we have made causing us to lose sleep at night? Gentle reminder, please like this video. Do not convert investing into return on emotion or return on stress. One way to overcome this is through diversification. You may say, I will not invest more than say 5% in one stock, however good it looks. Or you will not invest more than say 25% in equity. The rest of the investment could be invested in fixed income, PF, FDs, bonds. Balance could be in real estate or commodities such as gold, silver, crude. Use negatively correlated assets to build this portfolio. My personal choice are the multi-asset funds which invest in each of these assets. Also actively rebalance based on the risk-reward outlook from time to time. It removes emotions which an individual investor succumbs to. Fourth is buying cheap. It is easier said than done. It is relative. For example, a price to earning ratio of 20 was considered cheap in the past. Today, a stock at 40 PE probably looks cheap. Why? Because of the huge demand and less supply. If you see the monthly investments by retailers made through mutual funds SIP route, it was 3,000 crores 7 years ago. Today, that amount is 17,000 crores that is being invested every month by retail investors. We have only 400 stocks that are investable grade. The SIP investments of 17,000 crores every month is being invested in chasing the same 400 stocks. Still only 4 crore Indians are investing, which is less than 4% of the population. If this increases, the fund flows are only going to increase even further, chasing the same 400 odd stocks. Bubbles will get built, burst, and built again. So how do we avoid this? If we plot how stocks appear in relation to their worth, we have stocks that are great businesses but are at an expensive valuation. Many consumer names today, which are great businesses but have a very expensive price tag. You look at the SME stocks or the microcap momentum, these are fairly good businesses, but they are at a very expensive tag. These are the two quadrants where we must watch for bubbles being formed. Then there are areas where the business are fairly good or great, but the valuation still is not too expensive. These provide relatively safe avenues to invest. Fifth is to reduce the number of decision points, that is to reduce the number of mistakes we may do. Very underrated and lesser known that mistakes will be made in investing, as investing is part science and part art. So focus must be on making fewer mistakes. Reducing the number of decisions can help in this. If you have not watched this video on this concept, please check it out here. I will provide the link in the description. Cash is the king strategy. 6 to 12 months of cash must be kept aside in liquid accounts. They keep us in the game no matter what. Life will always throw surprises. Cash will be the lifeguard. It also helps us buy rare opportunities. Berkshire Hathaway, Warren Buffett's company, is known to hold cash in their portfolio. During the global financial crisis of 2008, Warren Buffett was able to pump in $5 billion into Goldman Sachs after the Lehman collapse. While it helped in boosting the confidence in Goldman Sachs, Warren Buffett also netted about $3 billion of profits, all because he had cash that he held with him. 6 months of monthly expenses is really helpful. It can also allow you to take advantage of a crisis. So where do you hold this cash? Security and accessibility are key to this cash. So keep it simple, keep it liquid. Simple savings account or money market funds will help here. Many investors look at optimizing and earning more interest on this. Take additional risk. This investing is not for growth, but for other benefits. Peace is the key to our financial health. When you hold cash, it means you're avoiding debt. Debt is a big source of stress in our lives. If you have debt, then you do not have to worry about any other external bubble. Debt is the biggest bubble. It's like a slow poison. Consumption behavior is driven by easy availability of consumer loans to buy the next phone or the next gadget. This is a big bubble. So in summary, bubbles form in every aspect of investing. They become bigger, they burst, and then they form again. I hope this framework help you maneuver the bubbles in investing. If you like this video, consider subscribing to this channel, liking it and sharing it with your friends.